Money Talks. It's time for the big fat idea. Very pleased to welcome back to the show Neil McIver from McIver Capital Management, Richardson GMP. Neil, just talking about that bump in rates in the States and the forecast of more to come. What's your big idea for us this week?
Well, good morning, Michael, on this very cold morning. But my big fat idea is really to tactically review portfolios with an eye to significantly decrease folks' exposure or to sell, quite simply, interest-sensitive positions such as mid- to long-term bonds, high-yield bonds, traditional preferred shares, utility stocks, bond mutual funds. Really, Michael, anything that will be negatively impacted by higher interest rates or inflation, or at least the expectation of inflation. And then on the reverse side, buying or adding positions such as real return bonds, floating rate preferred shares, and potentially even adding a few U.S. mid-sized growth stocks to the portfolio, priced in U.S. dollars as well.
So you're seeing this huge shift in interest rates, or the potential huge shift, but there is a shift in interest rates, and people better, make sure that their portfolio may have been structured for these lower rates for the last several years. I think it's a great suggestion. You better have a long look at that one again.
Yeah, absolutely. I mean, Trump's victory really is a catalyst to a great degree. I mean, things were changing prior to that, but I think Trump's victory was certainly a catalyst. The sand is shifting beneath their feet. And after, years of artificially low interest rates, money printing, and anemic growth, we may be moving into an environment with higher interest rates, some inflation, a higher GDP growth. It's really, quite a dramatic shift. And, of course, you saw part of that on Wednesday. My concern primarily is complacency among investors, both individuals and professionals alike, because for years, decades really, it's been really easy to buy and hold interest-sensitive investments and do quite well. Falling interest rates provided capital gains over and above any income that folks were receiving on those bonds or preferred shares. But the world's changed, and keep in mind that Trump was elected on a platform of cutting personal and corporate taxes, deregulation, infrastructure spending, and it shouldn't really be a secret to anybody that such policies have a tendency to speed up the velocity of capital, increase economic growth, and eventually generate higher interest rates and inflation.
So, give me a couple of examples of how we would do this as investors.
Well, there's a number of different ways, and I think the most important thing is to understand that to take these suggestions in context, you still need to own, bonds to a certain degree, high-yield positions, U.S. Canadian equities. So it's really about a tactical shift from one asset class, to another, without completely throwing the baby out with the bathwater. But the first thing you'd want to take a look at is Government of Canada real return bonds. These are fully guaranteed by the Government of Canada. They pay an interest rate of anywhere between 1.25% to 4%. Plus, the principal value of the bond increases with the rate of inflation every year. So if your bond pays 2% and inflation's running at 2%, you're going to get a 4% rate of return. But if inflation pops a little bit up to, say, 6%, your bond is now going to pay 8% as a yield. So there's various issues of these bonds going out anywhere between 15 and 30 years. They're highly liquid. They can be bought and sold on any given day. There's also rate reset or floating rate shares, which are similar in nature, but they've got a higher income associated with them, and obviously it's tax preferred here in Canada. And some of them getting a yield of up to 6 to 7%. On the growth side of the equation, if President-elect Trump is successful in increasing America's GDP, the most likely sector of the U.S. economy that'll benefit will be U.S. mid-sized growth companies, and these are established, profitable companies, just not quite yet the size of Apple or Facebook. And a simple way to access this market would be through an ETF. There's a particular one that I like called the iShares Russell 2000 Growth Index. It's already up about 12% since Trump's victory. Its symbol is IWO. It trades on the Amex exchange, but that's a solid bet to jump into this party that I think is going to take place over the next little while.
And only a few seconds left, but I mean, this to me seems appropriate for everyone. I mean, they've got I love your review ideas. I say, have a look at some of these others. You're still going to own something fixed income maybe in your portfolio, but it doesn't mean you don't examine them, as you say, and prepare yourself this way. I mean, I guess it's like crystal ball for a second, Neil, but, are we looking, this is not a trend that's going to end this weekend, if you know what I mean.
Absolutely not. No, for 30 years, interest rates have been coming down. Obviously, that was exacerbated with the financial crisis in 2008, and artificially, rates have been pushed down. So, this is going to probably continue in excess of 5 years into the foreseeable future. I mean, growth.
I got to leave you at that, Neil. Sorry, time's up. Neil McIver, McIver Capital Management, Richardson GMP. I'll be back in a moment. Much more coming your way.